Hey everyone, thank you so much for joining us. I'm here again with my brother John Ward, practitioner up in New Hampshire with the NNI, and myself in Iowa. And we're commencing again talking about becoming your own bank or starting policies and all this. And so today we just thought we'd jump in and share with you, bring you into the conversation
Yeah.
because we just started talking and I said, we really should be recording this. So thanks for listening. I hope you find some value here. And if you do, please subscribe. I'll mention this again. Obviously, everybody that's doing these blogs is asking for that because it's helpful. So anyway, what were you just talking about, John, before we uh, turn this on?
Well, I was saying that, you can you could put your money if you have that you have money, and it's not just to pay your bills from the outset, which is the way most people think about their money. Hey, I gotta have extra money. And so let's say you had $10,000, you could put it into a mutual fund, or you could put it into individual stocks or stocks. And that stock or that mutual fund has to perform, right? You
Yeah.
can't have it perform and utilize the money at the same time. So we're using the comparison to a permanent whole life policy that we would structure for somebody. And you could put the 10,000 in there, and you could eventually leverage that money
Hmm.
maybe to do some of the same types of things, whether put it
Yeah.
into a stock or. And so I said, really, there's nothing like it. And then I said, well, maybe a house, like a three family, fourth family. So, hey,
Yeah.
I can get income from it, maybe, right? Some extra cash flow over my expenses.
Yeah.
Um, but then I might also be able to tap the equity. So I can use it sort of twice. And then you made a great point. So I'll let you
Huh.
make that
And
point.
then I said something to the effect of, well, that's if they let you tap it, the
Yeah.
equity, if they want to give it to you. And if they do want to give it to you, they aren't going to give it to you this week. You're going to have to send in, some information, how's business going, right? They're not going to give it to you. And the other thing of it is when they do give you that loan, any kind of loan, right? Whether you're talking about car loans or anything, at any time they can call the note. Like it wasn't it when we had started the landscape business and our friend, I'll just say Michael L.
Yeah.
was a sheetrock guy and he was buying real estate all over southern New Hampshire. And the banks started, and he was he was positive. They started calling his notes. He started calling the notes on his houses that he had invested in, and they actually put him under.
Well, yeah. So I don't know if you remember, I think I've shared this story with you. So this gentleman, Michael L., sheetrocker, you know, Ray and we had started a landscaping business back in 1986
Yeah.
together. I was only a couple of years out of college, and we shoestring the whole thing. And Mike happened to be one of our Michael happened to be one of our clients, and he lived in my neighborhood actually.
Yeah.
And I was still living with dad and so forth, but um, we thought he was amazing. He was going 1,000 miles a minute, and he was making a lot of money sheetrock, and because there was a lot of construction. This was still the
Yeah.
boom before the bust, and he was riding high, and he was buying a bunch of properties. And it was only like it was probably 1988 or so. So a
Yeah.
couple years later, you and I had gone separate ways. And I think I had got back into the landscaping business. I took like a year off doing something else and then started up my own thing. But during the winter, I took a temporary job, and it was with a mortgage company called ComFed. And it was downtown Lowell, Massachusetts. I would go in, and I was a collections guy. And I remember having to read all the rules of what you could say to people and everything, but you'd get a screen pop. This was the next person you had your headset on, the next person you had to call, and yeah, you were a bill collector. And one day, Michael L's name came up on the screen, and I literally didn't give him my name. I didn't, I mean, I gave him my first name. My name's John, but I didn't let on who it was. And it's not like he was a little more friendly with you. You are somehow knew
Yeah,
him first.
yeah,
That's how he became one of our clients, right?
yeah,
And so he didn't probably wouldn't recognize my name. I talked to him very few times. I saw him once or twice, over at his house. Um, but literally he had multiple properties that were being foreclosed on. That's what we were doing. We were calling, trying to collect you know, before it went haywire, completely haywire.
yeah,
And as I remember, like so many did, including one of our cousins did something roughly the same. There was a mass exodus out of New England to North Carolina. And as far as I know, he lost a lot. He might have lost everything.
yeah,
But he was a guy that could probably rebuild if the economy rebuilds. And he went to North Carolina. And of course, there's been an incredible boom over, 20, 25 years, 30 years, right?
yeah,
Um, and so I'm sure he learned a lot from that, right? But yeah, they come after you, and if there's no safety net, right? Because as I remember, he was not just buying houses, he was buying toys, and like so
yeah,
many did. And
yeah,
I always say that's a true sign of the economy's failing when you start to see people's boats on the front lawn. If the more boats you see for sale, tractors that are, all these, or what might look like an extra piece of an extra asset. When the more you see of it, the more likely it's that the economy is going the wrong direction because people are saying, I got to get rid of some of this stuff and free up some cash. And sometimes you can't catch up with that rolling snowball that's coming after you. You just can't, because if you've leveraged everything, or you have no cash anywhere,
yeah,
it's gonna
yeah,
it's gonna bite you really bad.
yeah. If you're over
Run you
leveraged,
maybe
and a
run
lot
you
of
right
people,
over.
and a lot of people were doing that, including Nelson.
Oh yeah, oh yeah,
That
yeah.
whole thing for him, how he got into this all was this. It's the same scenario. So if you're leveraging everything, and it doesn't have to be everything, but if you're leveraged, how much do you want to be leveraged? Can you cover the leverage yourself?
Yeah.
And so if everything's going along merrily, if you get past that time frame, the ups and downs of the cycles, and you're riding it back up, and everything looks great, and you start, buying land or buying houses or, all that kind of stuff. How much are you leveraged? Because at any time, because you and I have lived through it, as we just explained, that this stuff does happen. And there is a generation that they have never had that happen. They can read about it, but unless you've lived it, it's
Yeah.
it can be difficult to relate to, like to feel it viscerally. Like I remember Michael L. pulling up to stop and talk to us sometimes in his BMW, a brand new BMW, and yeah, I'm buying this house and I'm buying that house. He was doing great until he wasn't, and he didn't have a net to catch him.
he looked like he had the world in his pocket, like
Yeah.
he
Like so
looked,
many did. So
yeah,
many.
he looked indestructible, not just the way he carried himself, but the way he looked. He was tanned, he was strong, muscular, he was
Yeah.
charming. Uh, he was a
Yeah.
nice guy and doing well, but he was willing to share how things were going and what he was doing. And then, yeah, it fell apart for him. And
Yeah.
it's funny you brought up Nelson. And of course, we talk about Dave Ramsey from time to time. And Dave Ramsey, I like to say, is he went bankrupt, and he's now spent the rest of his career talking about how bad debt is, and it's really the use of the debt and what are you leveraging, right? So if you say you're over leveraged, you could be over leveraged, well, maybe not over, but you can be maxed out on your leverageability in a policy, um, where, of course, you keep adding to it every year through your premiums, but you could have tapped out every last dollar you could borrow against. Um, but what you're really doing is you've got this asset that isn't going away, hopefully anytime soon, which is you. You are the asset. So nobody's going to come and take you, right?
Right.
But when you
Right.
die, if there's any outstanding debt, then it's just going to come off that death benefit. Yes, so your heirs, if that was even part of the equation of your thinking of doing this, well, then they're not going to get as much, because of the fact that you leveraged, and then those investments maybe that you were making didn't work out,
Yeah.
come to fruition, or maybe they did. So there's these outside assets too, right? So it's not just like, hey, I've got all this debt and I have less, left over for death benefit, you know, to share with my heirs, but you do have maybe some of these other assets that you bought with money. So yeah, I look at it like, well, Nelson, that I think without going crazy, he was trying to say in the book that I just really wasn't thinking. I just got swept up in maybe the fear of missing out, or hey, a little bit of greed stepped in. He was a forestry consultant and he bought forestry land because he knew stuff about it. But then he got into real estate development. So then starting to build, probably there was probably homes being built, or at least getting them prepped to have lots and all segregated and so forth on a piece of land. No. But he literally had a partner that went bankrupt. He said, I just can't go bankrupt. I'm not going to go bankrupt. So he took on not only his portion of the debt, which was a $500,000 back in the early 80s, and then another 350,000. And he went from paying 9.5% on that outstanding debt to, because it was 8 plus 1.5 for prime. So
Yeah.
he was paying 9.5, and overnight he said it went to 23%. So he had
Yeah.
about 800 or $850,000 outstanding.
Yeah.
And what he learned was not that debt was bad. It's just that you can't overexpose yourself to things, and because you were utilizing the traditional banking system, um, you put yourself in a lot of jeopardy because
Yeah.
he's looking back on,
You had given up the control.
and that if he was, thankfully, that's how he got himself out, because he was putting in pretty sizable premiums for that day and age, but he clearly was giving away a lot of money, even at the 9.5%,
Yeah.
meaning he wasn't being his own banker yet.
Right.
Like if he had tried to do all those things, being prudent and say, "Oh, let me become my own banker. Let me set up my own banking system first, and then whatever I can do from that banking system, that I would do, because I like it and interested and I see opportunity, then yeah, you're not going to be in this place where now all of a sudden the tide goes out and you realize your bathing suit's down around your ankles. And that's you're exposed. And it was painful, very painful experience for him.
for a long
But man,
time.
that's why he got passionate about becoming your own banker.
Yeah, and he came to the whole idea of this through that pain, you know, and there's many of us struggling, you know, with all of this, even now, even today, right at this moment. And if you really think about things, that's what happened to Nelson. He just kept pursuing, there's got to be a way for me to get out of this and not have to file bank. He just didn't give up on that. And it's the same with this. Don't keep doing your own due diligence, keep digging yourself, to get to the point where you say, aha, you know, here's something I can do. I was out on a bike ride this morning with my buddy. And yesterday, when we went out on a bike ride, after the bike ride, we came inside, and I was sharing with him some of these books right here. These are I got two piles of books here, John. The ones on the left here is a small pile of what the problem is, and then here's another pile. These are the solutions. It's basically people like us writing about the solution, you know, and I was sharing with him a couple of these books, and I pulled out uh, Mark Benson's book, and I was telling him, you know, there's loads of different ways to talk about this. There's lots of different ways to philosophically think about how you want to create a strategy using this. There's all kinds of ways. There's practitioners talking about, oh, this is what you got to do, or this is what you can do. You should do this, you should do that. We're all talking about it, the same thing, but different things that you can do. And I just happened to pick out Mark Benson's book and pulled out the little postcard, I'll call it, that he has tucked inside his book. And I was just showing him, you know, the red and the green, and that you know, Nelson and Mark Benson has got people that are running their entire income through the system of life insurance. And it just dawned on me this morning that my buddy, my bike ride buddy, is probably thinking, well, why would you even want to do that? What's the advantage? Well, you know, so when I was out there with him this morning, I said, hey, I just wanted to clarify something, and that is, why would you want to do this? Well, number one, because the money that you have inside your own banking system is growing perpetually, forever. It's never interrupted because you're using other people's money to do the things you want to do, which is, you know, buying cars and houses and vacations and all this other stuff. And why else would you want to do this? Well, the fact is, you're already doing it. You're doing it, but you're doing it through somebody else's banking system. Why wouldn't you want to do it through your own, where you capture the growth of it inside this system? And he just kind of went, oh, yeah. He just kind of nodded his head. He's not like going to go off and get into all his thoughts about it, but he just kind of nodded his head. Yeah, that's a good point. Um, so and again, there's lots of ways we can talk about that. Hence, you know, all the different podcasts that are out there in the world now. Everybody's making, we're all talking about the same thing, but in so many different ways. Like I was saying to somebody that I got on a call with recently, that I prefaced the whole call and said, you know, there's lots of people that are using all these graphics and spinning things and different terms, you know, magical and all these words. And I said, I'm just not like that. I just want to speak the way I want to speak, and for me, who I am. And it's very simple. I don't have to have all this colorful stuff. Um, and I'm not saying anything. I don't want to sound like it's saying anything negative, because I think anybody that's out there talking about this in the correct way for it to be used, I applaud them. I want, because there's a shortage of us out there actually um, explaining this, because the noise is so loud the other way of putting your money in the market, um, that you put your money in the market, like you were saying earlier, right? Did you already cover this? That you were saying, you put your money in the market, it's there. It's just like the house. That's how we get on the whole thing about the house and having equity. Was you put it in a 401k or an IRA or whatever, it's in there. It's not like Caleb wrote that book, The And Asset, it's not an and, it's either there or it's not, where with the whole life, you have it in there, it's growing in there, but you can also use it as collateral to get a loan to go and invest in something else or whatever. Yeah.
And we were referencing it, the control option from Mark Benson, and that my old podcast co-host, that was the name of Doug's business. Was oh geez, I think it was like, I'm sorry, Doug, if you're listening. Uh, Control Capital Solutions, I think is what it's called. And it's that one other piece. Like, we just keep adding these pieces that you say, well, what's that thing that's going to finally get me to understand it, and say, wow, how powerful this is. It's not just that you have access to it, right? That you're to get your capital, that it's liquid, but that you have control over it, right? Like, of course,
Yeah.
the policy grows the way the policy grows by the way it was structured and by dividend payouts when they are paid out, all that. But you have control. If it's an asset that has value, you can go get it, right? You might
Yeah.
not be able to even get it out of that house, out of that 3-4 family or whatever it is that you created, that because you were looking for either the regular income that was going to come from it, right? And that eventually that will be paid off by the renters, maybe you and the renters if you live there too. But you're going to have this asset that maybe someday is worth 500,000. There's nothing wrong with that. But the fact is that we're talking about a different piece of property that you have control over.
Yeah.
That you're still going to end up, depending on how you structure it and what you're putting in. Let's just say someday you're fully paid up on the policy,
Hmm.
but the current cash value is the same as the current value of that four family, say. And let's say
Hmm.
the four family, after it's paid off, fully paid up, now it's worth 500,000. The same, yeah, same thing can happen with the policy. It can be worth 500,000, right? Like, it's current value. And that's what the real estate market is. It's whatever the market decides,
Yeah.
but your policy, it's guaranteed to keep growing. It's not going to be subject to sometime like 1987, 88, where all of a sudden stuff's not worth the same. Real
Yeah.
estate's not worth the same. It loses 20%. I don't even remember exactly. It
Yeah.
lost a lot because we were in a total real estate boom. And
Yeah.
hey, none of us knows when the music stops. But what we were saying earlier is that we do have the life experience that the music has stopped a couple times. And,
Yeah.
what position are you in when that happens? But that's not about fear mongering. It's saying we're talking about being really smart now, not just for the future, but being smart for now. that
Yeah, yeah,
I get to use the money all along. I don't have to wait for some future disaster to make this look good. No,
yeah,
it, it looks good pretty much the whole time, especially if you understand it. It all looks good. It's
yeah,
just like, I'm going to just build my financial house on this solid foundation. You wouldn't build a house like we live in on anything less than a solid foundation and expect it to stand, right? And
yeah,
now we're taking chances. It's like saying, "Hey, I'm not really gonna do this slab that I'm gonna build my house on. I'm not gonna do it maybe by the book. I'm gonna lay it out, maybe not have any um what's that stuff you put in the wire, not wire, but rebar. I'm not putting any rebar in it. I'm not, like, getting it to stay together. I'm just kind of slapping it together and that it might crumble, right? You wouldn't build your house on that. But I think these other products, you have to realize that there's some aspect of that, that you're actually not doing it in the best, you know, way, a standard way of building a foundation.
yeah,
IULs, variable life, and then just the idea that when you do other types of investing, there is some level of risk. And it can be the stock market. It could be any kind of investment that you're doing, right? Any business that you're putting yourself at risk, but hopefully it's calculated risks and all that. But we wouldn't build a house like that and say, I think that's good enough. It has a chance of crumbling, but maybe I'll outlive it before it crumbles. And that's what I think some of these products in our industry. I'm not just talking, I mean, I kind of I gotta say, when someone asks me what I do, one of the sometimes I say I'm in a niche of the financial space, financial services, But of course, that conjures up something else. So I got to maybe share a little bit more if they're interested. Otherwise, they just kind of think, yeah, I'm selling stocks and mutual funds and all that. But to me, you know, we're talking about trying to do the best thing for consumers and what's good for them long term. But it's not just some distant future. Yes, think about it long term, plan it, do all this kind of stuff, but it has real use now. That's huge. That's absolutely
yeah,
huge.
yeah, yeah.
Thanks for letting me ramble in.
Um, I wanted to just say that, that what makes this different is that, the whole life policy is really a savings vehicle, which takes it out of the realm of investments
Mhm.
because it is so liquid, that it isn't categorized as an investment. Although you'll hear people say, well, you don't want to make that kind of an investment. Well, it's not an investment, it's a savings vehicle. It's really that simple. And the way that you know that it's a savings vehicle is that you have access to it. It's liquid. That's the difference. Like your investment, yeah, you can go and get that money, but how long is it going to take you to get it? And it's going to stop growing as soon as you do that. Now the difference between a savings account here and a savings account in the bank is also the same thing, that as soon as you take it out of your savings account at the regular bank down the street, it stops growing. So it just has that added benefit um, to it. The other thing I want to say too is that, thinking long term, because really that's what we should be thinking about. What is the legacy that we want from our life? Our life, it really isn't about us. It's not it is maybe for us, but it isn't about just us. It's about all the future generations that you'll never know that are going to be affected by what we do. And so thinking about it long term, when I think that part of our goal and all the other practitioners in this space, our goal is to get to start to do this so that when our clients do get to be 65 or 70 years old, that they thank their 35-year-old self or 45-year-old self, thank them for doing this. Because you are going to arrive, unless you get hit by a truck or something else, you're going to get there. And you and I are full proof of that, because it doesn't seem that long ago that we were playing baseball out on the fields, running around like crazy. Doesn't seem that long ago, but to be able to
Took that line drive right off the chest that you hit at me. You felt bad, of course.
for a moment.
It was a hell of a hit.
Oh, yeah, couldn't move quick enough to get out of the way.
No, no.
Oh,
Somehow it hit me just right so that it didn't do any damage, but it knocked me right over.
oh man.
Ah, yeah, and
Yeah,
having grown up together, that does seem very recent. And of
yeah,
course, it was is well over 50 years ago.
yeah, yeah. So I want that statement that I just made, that all of us are really trying to get to a place that our clients will thank their 35-year-old and 45-year-old or 55-year-old. I recently heard that from a guy by the name of Bobby Samuelson. I was just looking up what his name was.
Yeah.
I had
Mhm.
recently got introduced to him, and he was the one that said that. And I thought, that is so true. That is precisely what one of the objectives is, that our 65-year-old will thank our 35-year-old. And you only have one shot at it. It's like these 401ks. You do that for 35 years and then you retire and you find out, maybe that wasn't such a great idea. Maybe it was for some, but that's what we're really after. So anyway, um, anything else you want to add to this? Um,
Not really. That it's just coming right out of my head here. I do say that I did think when you were talking about investments, because first of all, these policies are not considered even by the IRS as an investment, and that's why they have the tax-free advantages.
yeah.
Um, but I say it's an investment in you when it's very much along the lines that you're talking about. It's an investment in the here and now. It's an investment in your future, which is every day from here and now. That is your future. Tomorrow's our future, 3 hours from now, all that kind of stuff, really. But it's not the kind of investment we're used to talking about. It's it is an investment in your financial life, which you can't separate, sadly, in some ways. Or you could maybe try, and you can get into a good spiritual place in your life, good balance. But really, our financial life intertwines with everything else in our lives so much that, yeah, I look at it is really the best investment you can make. If this was the investment all of us started with, then all those other so-called investments or opportunities that you take advantage of all can be done from you making a decision. And that's what it is. It's a decision you made, just like And that's what you have to think about is I'm always making a decision, even if I just put it on autopilot. We've autopiloted the decision making, right? And we just say, okay,
Yeah.
we're just going to do it. And next thing you know, 35 years have gone by and this is what you did. And then you didn't really think about it. But even just remember that, they're going to reassess things every day, but you can reassess and go, yeah, maybe I should learn about that.
Yeah.
And we're just doing this hoping, someone listens to it and they pass it on to somebody else and somebody else learns something. I mean, that's what
Yeah.
the whole world's about is if we share stuff, then, it's going to touch some people and it's probably going to hopefully touch the right ones at the right time. And, it'll be good for their lives.
Yeah.
We would have done this so much earlier in our lives. That's why
Oh,
we're that's why we're so passionate about it. We want that for other people
yeah.
because we know it would have made a big difference in ours if we had done it earlier.
Yeah. Yeah. Well, yeah, and part of the reason of sharing it is that if it helps us and it helps more people, it will actually help us as a country, as a global community. It will help everything.
Yeah, I
Um,
agree.
yeah.
I agree.
So I just wanted to say that I'll kind of go back to another subject we touched on earlier, or I touched on, was that there's so many of us out here talking about this in so many different ways. And so me just saying that this isn't not an investment, it's a savings vehicle. Just because I say that doesn't mean that that's the end of it. Because for somebody else, they could still want to think of it as an investment, like you were just talking about, right? So I just want to give you an example of being accepting somebody that poses it in a different way doesn't mean that they're wrong and you're right, or vice versa. And I want to use this as an example. This is a book that recently came out, The Perfect Investment, and it's written by Carlos Lara, who is a board member of the NNI, and it's a
Nelson Nash Institute.
compilation. What's that?
Sorry. The Nelson Nash Institute,
Yeah,
just
the
for those
Nelson
who
Nash
don't know.
Institute. And it's a compilation of papers that he has put together, or somebody helped him put together, because he had a stroke, obviously, and he can't he can't function the same way he did. He didn't come all the way back, but he's still quite with us.
Oh, yeah.
But
Yeah.
so
What a
even
treasure he
he
is.
even he used the word investment on the book. So I'm
Oh,
just I'm just I'm just trying to make the point to be open, to be accepting to people's different ways of expressing the same thing. The vehicle itself isn't changing,
right,
it
right.
was
Just because
current,
of how we describe it. Yeah, exactly.
right.
The concept is still not just theoretical,
Yeah,
conceptually, but yes, in application, it works. It just does. And there's no client of mine, including myself, because I am my own client.
yeah,
Uh, yeah, that would ever say that this was not, it was a huge benefit. It was, they never going, oh, geez, this isn't right. This isn't for me. This doesn't work, or I made a mistake.
yeah,
They're always reminded in conversation um, when we talk. They're like, wow, yeah, thanks again for, just kind of bringing me back in line and
yeah.
because I get a chance to talk about it all day, every day, and think about it. I still think about it all the time. And it's not like, oh God, I've had enough of this. I'm never like that. Honestly, I've never had anything else in my life where I felt like that. No work have I ever felt like, oh God, do I have to go do that? Like, no, I want to do more of it. I want to share it more.
Yeah,
Yeah, and I want to share with not just prospects. I want to talk to my clients about it because they made a good decision. sometimes it helps for them to have it reinforced.
Yeah, I would say ditto on that, that's definitely something because there's so much that even you and I revisit, and then light bulbs go off, you know. So for our clients, yes, you want to keep in touch, right? And if it's through this mechanism, wonderful.
Yeah,
However, people can consume it and listen. Anyway, well, that's
sounds
about all
good.
I have, Johnny
Yeah.
Ward. Uh,
Yeah, Raymond Wood. That sounds great. Till next time. Thanks for
yeah,
listening.
please do subscribe and share this. And if you ever want us to speak to any groups that you're part of, we'd be happy to do that or speak to you yourself.
Okay. Sounds
Until
great.
next time,
All right. Enjoy your day, Ray.
you too, John. Take
Bye,
care.
everyone.